have an impact or effect, or even to conduct their business across borders. Then crisis management groups. To what extent are the various regulators within the financial sector or other sectors working together in identifying, managing both pre and ex ante and ex post of crises? How do you determine whether an institution is a candidate for resolution or not? Then recovery and resolution planning, and more importantly, matters is number 12, the access to information and how you share information. So the resolution cycle. The first question normally is the bank viable? Viable along very many parameters. Is it capitalization? Is it the extent of the loss-making loss-making characteristic of the bank or the institution? Does it lack liquidity? Are there shareholder issues, or is the shareholder distressed? Corporate governance, which tends to be the source of the majority of the issues. Are there weaknesses? And then at that point in the decision process, a decision has to be made whether a takeover should be done or not. And if the decision to take over has been made, the next question, and that's why I put those two boxes in red, is a decision has been made, in sense for banks, whether it's systemically significant to the extent, the degree of its interconnectedness across the economy or within the financial system. Then the decision is made whether you have an orderly wind down, in which case the deposit protection schemes, deposit insurance schemes come into place, or you make a decision on what kind of resolution regime. Is the focus on continuity? Is there an option for continuity? Bail-in, transfer of assets and liabilities? Is it better to arrange temporary public ownership where you rearrange management and perhaps recapitalize it and bring it back to market, similar to what was done for institutions like Royal Bank of Scotland or AIG in the US? And then in the event that you have agreed a resolution regime, if there is any residual assets or residual institution, how is it dealt with? Its assets and its other resources. So for Uganda, I tried to summarize largely how the decision is made. So the first objective is we want to ensure that there's continuity in critical functions. The next is contagion. How do we avoid it? Not just minimize it, but completely avoid it if it's possible. The third consideration, and in no particular order, but the third consideration is financial stability. To what extent is this resolution decision going to have an impact on the stability in the financial sector? The next one, what's the impact of a resolution decision on market discipline? Does it increase existing moral hazard considerations? Does it remove them? Does it encourage or foster the right kind of behavior we are looking for? Then there's the issue of use of public funds in the resolution. And then safeguarding depositors and covered investors. Those are the objectives of any resolution decision. In at least for Uganda's case, looking at the history, those have been the kind of objectives that have guided us. Of course, these are more or less primary. There are probably other secondary ones, but I chose to focus on the primary objectives. Then what are the triggers? What's the likelihood of the failure of this institution? Is there no alternative private solution to avoid a failure? And is its resolution in public interest? For those who are lawyers, public interest, even defining it remains very vague. But those are things that are the triggers that make you decide. Yes. And lastly, when you look at the principles of any the resolution decision, are the covered depositors protected? The priority is always the first one. And we'll get to the Ugandan experience. And because in Uganda's case, on principle number one, in 1998, in the resolution of Greenland Bank, this kind of the Greenland Bank in liquidation, the government made a decision to cover all depositors in full. Okay? The condition of equal treatment of creditors, I believe that's the Latin translation, I will not attempt to pronounce it. But the whole idea is that creditors of the institution that's being resolved are all treated equally, or at least according to the pecking order of finance. There are issues there, whether it's the replacement of management and directors, how it's going to be done. And the other one is that the resolution burden should be shared with the shareholders. So the framework in Uganda, the laws, the guidelines, the regulations that we currently use, one is the Financial Institutions Act, specifically I think from section 85 down to about 96. Those provide for the powers of the central bank as the supervisory authority, which has also been taking on the resolution authority role, and gives the powers in regards to how institutions are resolved. With regards to risk and problem identification, we have a risk-based supervision manual, and we have in place a regular supervisory cycle and supervisory reviews. The next is we have a series of memorandums of understanding with peer regulators across the region, especially with the EAC, and through supervisory colleges with the home regulators of the multinational entities or financial institutions operating in Uganda. On the fifth one, sound and comprehensive framework for bank resolution, we are in a development stage for a problem supervised financial institution resolution guideline, which is currently under development, but it basically is building upon our experience as Bank of Uganda since our establishment in 1966 to date. And then most importantly, we have the sufficient human and financial resources in terms of the training, in terms of the experience they have gotten with having secondments to regulators that have got experience dealing with resolutions. So, the resolution experience. Like I said earlier on, we've resolved 7 banks since 1986. In actual fact, since the establishment of Bank of Uganda in 1966, all the banks that have been taken over and or resolved have all occurred in the space since 1986. So for the first 20 years of Bank of Uganda's existence, it was smooth sailing, so to speak. I'll start with the last one, Crane Bank, which has been the most problematic. Resolution date was October 20th, 2016. The triggers were undercapitalization, insolvency, and the failure to recapitalize within a specified period. But also, more importantly, there were governance issues for this institution. The resolution type and process, first it was a takeover of management and of the board, which according to our act is termed the statutory management. And in that period of October 2016 to January 2017, Bank of Uganda, as the resolution authority, did inject liquidity support. Now, the decision to take this approach for Crane Bank was, it was a systemically important bank by our own definitions as Bank of Uganda. During the period, there was the conduct of a forensic audit. The bank was moved into receivership in January, and the sale of the bank within the provisions of the FIA was through a method which we have since preferred since about 2010 of the purchase of assets and assumption of liabilities. There was an attempt to work out a confidential settlement and release agreement with the key shareholders, and then the residual assets and liabilities have been retained by Bank of Uganda as the receiver. Subsequently to failure of the confidential settlement and release agreement, Bank of Uganda then filed a case against the shareholders, and the receivership process is ongoing. just to give you an update, our initial filing of the case has since been set aside by court, a process which we are appealing. So in other words, that our resolution process, we also subject to the normal court process. The challenges, and this is where once you have all the necessary regulations, laws in place, a lot of care must be taken. From the Ugandan experience, the procedural mistakes, both during statutory management and during the receivership process, some of which we have paid dearly for in terms of the erosion of the central bank's reputation. We've taken quite a bit of a drumming through the press and through the various parliamentary committees we have had to interact with and provide accountability to. There was the failure of the attempts to resolve out of court the confidential settlement and release agreement, and then the court processes. Remember, the case was filed in June or July of 2017, and the ruling was only made in August of 2019. Then, of course, the parliamentary probe, which, right as the parliament does have oversight, the issue was that to what extent are they diverting the resources of the resolution authority from the resolution process to focusing on answering questions. Perhaps it would have possibly been better if the questions were to be asked after the process has been completed. And of course, there was also the issue of incomplete records and documentation for the liquidity support. Global Trust Bank, the resolution date was July 2014. The triggers, the major trigger really was shareholder fatigue. It had gotten to a point, this was an institution that from its inception, about 4 years before, had never turned a profit. So it had not demonstrated the ability to be able to grow its own capital base organically. So it got to a point where literally every year, there was always a capital call. So it gets to a point where you ask, at what point, how sustainable is this? So when the shareholders demonstrated a bit of what I choose to call shareholder fatigue, then it became apparent to the central bank that something drastic needed to be done. Now, the resolution type for this one, considering that it was a bit of a smaller bank, was we had a statutory takeover and closure by the Bank of Uganda, the purchase of assets and assumption of liabilities agreement, and then immediate transformation into liquidation. So, statutory takeover was on a Friday. The purchase of assets was done over the weekend, and on Monday, the institution, with the assets and liabilities transferred, was then moved into liquidation for within the residual assets. This one has been a problematic one because there have been numerous legal suits against Global Trust Bank in liquidation. So it's one of the reasons why it still remains incomplete. However, we've since made some significant progress, and we have had discussions with the shareholders, and it's our plan and intention to have this particular bank whose resolution concluded by December this year. National Bank of Commerce. National Bank of Commerce, there were shareholder disputes. At the time we stepped in, there were majority shareholders and minority shareholders, and there was a legal action by minority shareholders against the majority shareholders. So, and at that time we had put in a capital call, so then the issue became how would they contribute the extra capital if they could not agree on who owns what. So similarly, initially we started with an interim management oversight, and then that was progressed to a statutory takeover and closure by the Bank of Uganda. There was a P&A agreement, and then liquidation, similar to Global Trust. The challenges. When you look at the existing law that I mentioned, the Financial Institutions Act, it actually prevents the entertainment of any proceedings against the liquidation or bank resolution process against Bank of Uganda. But somehow an injunction was issued, and that stopped the sale, the process of liquidation. So while the P&A went ahead and the obligations under the purchase of assets and assumption of liabilities was taken over, the process of liquidation could not continue because there was an existing injunction, which, as an update, was only set aside in June this year. So from 2012 to 2019, that injunction has stayed any action or possibility of actions towards the liquidation of this bank by Bank of Uganda. The other challenge with the National Bank of Commerce is that National Bank of Commerce was bought by Crane Bank in 2012. And then Crane Bank itself was in turn sold off in 2016. So you can imagine some of the assets acquired in 2012, having a traceability process for them after 2016 when the acquirer in 2012 was taken over by someone else. And again, most importantly, if you look at the last challenge, there's been a lot of asset wasting. The injunction has stopped any action in liquidation. It meant that whatever assets, fixed or otherwise, that were not taken over and under the purchase of assets and assumption of liability, we had to put in storage. So imagine furniture or all the ATM machines that have been in storage for 7+ years. Now that we have the injunction set aside, it is even a question of what kind of value can be to pay off any outstanding creditors. So in a nutshell, that's really basically has been Uganda's experience. Now, what has been the impact on financial stability? Because remember we said one of the critical success factors is containing or managing contagion or avoiding contagion. Our preferred method for the resolution of banks has always been, since 2010, has been the purchase of assets and assumption of liabilities. The matching, and where there's a netting off, we either pay or they pay, the acquiring entity pays for the difference. Here are some interesting facts. Between June 2012, remember the first bank was closed in September 2012. Between June 2012 and June 2019, which covers the 3 banks I have mentioned, total assets in the sector actually grew by 110% to about 30.3 trillion. That's in nominal terms. Gross loans and advances, 89%. Customer deposits, 115%. So you might say, but perhaps those are just in nominal terms. If one controls for inflation and real exchange rates, perhaps it would be less. So we decided to look at ratios. For the same period again, under capital adequacy, looking at the ratio for core capital to risk-weighted assets, one would say there's been a slight improvement. So we moved from 18.3% in June 2012. You had an uptick after the takeover of the first bank to 21.3, and then a slow downward. It came down slightly to 20.3, and then since then has been oscillating between 18.8 or 19 and 20. Asset quality, another measure of impact or stability, the extent of stability within the sector. The non-performing loans to total gross loans as a percentage. The only time we see a significant uptick in or impact within on the financial stability point of view or perspective is in June 2016, when the non-performing loans to gross loans, the percentage went up to 8.3%. Okay? But remember, that is June 2016, prior to the resolution of October 2016. And the reason why you have this uptick in June as opposed to October, and the offsite of examinations which forced the reclassification of existing assets for Crane Bank at the time, is what bumped up the the total asset non-performing loans in the sector, and was the basis for the capital calls which were not complied with, and therefore the takeover by the central bank. Looking at earnings, return on assets. Return on assets dipped from 2012 has dipped slightly, but has remained constant more or less, with not big variations ranging between 2% to 2.9%. So it has fluctuated in a range of about 100 basis points over a 6-year period. Liquidity. The percentage of the ratio of liquid assets to total deposits has remained significantly comfortable, because remember our prudential requirement is 20%. So even despite the fact that we've had all these resolutions of institutions, look at 2012, look at the figure for 2014, look at the figure for 2016, we have remained so consistently above that threshold that would have caused us significant worry within the sector. So, in conclusion, I would say comfortably that the recent bank resolutions have not raised significant financial stability concerns, as credit quality has remained satisfactory and banks in Uganda continue to hold adequate capital and liquidity buffers. Now, earlier on we talked about enablers. So we've had the resolutions, we've seen the experience, we've noted that there has been a muted impact on financial stability. What are those things that we also have had in place or need to put in place that have helped us have this kind of experience, in our opinion, in our own assessment? Those who conduct an independent assessment might choose to disagree. One, I believe that one of the enablers for the experience we've had has been our focus on having the resolution of financial institutions guided by the principle of least disruption to the wider financial sector. Two, the fact that our licensing regime in Uganda is where we ring-fence subsidiary operations from the parent. So an entity registered in Uganda is registered as a subsidiary and is a standalone, as opposed to the branch licensing model. Three, we believe the information sharing channels and the common supervision protocols between the peer regulators, especially within the East African region, have been very helpful. Four, that there has been extensive multi-stakeholder involvement of the central bank, the deposit insurer, and the Minister of Finance or the Treasury. The other set of enablers, that we've had regular legislative reform and review of the regulatory supervision practices needed to strengthen the bank resolution frameworks, even though that review process has not yet been complete. So it's an ongoing process. We've also had, we try to maintain regular institutional profiles and access to data for timely decision making. Then there's the process confidentiality. The confidentiality around the processes or the conduct of these resolutions is equally as important as the method or the approach one uses or the resolution regime one applies to an institution. And so far, largely, we've been rather successful on that. Except that now, in the last 2 years, I would say that with the coming to age of social media and information anywhere, anytime perception, this is going to become increasingly difficult. But nevertheless, it's something that has helped us and been in our good stead to date. And then, of course, there's been the effective management of expectations and trying to minimize uncertainty. If over the period where we've resolved 7 co-institutions over I would say almost a 20-plus period, the fact that we have less than 20 suits by employees against the closed banks means that to a large extent, because these institutions combined probably employed closer to 3,000 people, means that to a large extent we have managed the employee expectations of uncertainty employees have whenever bank resolutions have occurred in Uganda. So now we turn to the lessons learned. Someone once said that prevention is better than cure. I agree. Risk identification. The development and the monitoring of early warning indicators. Strengthening the off-site and the on-site surveillance. And something that is becoming increasingly important in the day and age where banking is increasingly becoming synonymous with technology is having real-time data and real-time data analytics. 2, early intervention. So the idea of regulatory forbearance as much as possible should be removed. Corrective actions and follow-up. To what extent is it, how effective is the regime for corrective actions and the follow-up? Do you monitor, do you manage the conduct of these institutions and management behavior? Because remember, the institutions are entities that we have persons. It's the people within the institutions that matter. So perhaps we should begin, what we are looking at is beginning to consider and borrow from lessons in behavioral economics and behavioral science, that depending on how one sets up the incentive structure, one can influence and get the kind of behavior they want or they need. The behavior of the people within these institutions determines the conduct of these institutions, and if it's structured right, you then have, you basically minimize the possibility of them failing or failing in a significant way. The other one that we are also looking at in the lesson learned is rules versus discretion. Rules-based regulatory supervisory regime versus principles-based or maybe perhaps activity-based. When you have rules as the basis for your supervision and regulatory regime, there is not too much built-in flexibility. In a situation where the financial sector is constantly evolving, while rules are helpful, there should be some inbuilt flexibility, which means some extent of discretion or perhaps principle-based regulation. And then the other one, very important for us, has been crisis management. I would like to report that in Uganda's case, we've actually created a financial sector regulators committee, which includes the Deposit Protection Fund. And what we're trying to do is come up with a multi-sectoral or cross-sector crisis management plan. That's both ex ante and ex post. That in the event one institution in one subsector of the financial system is having a problem, what should the other regulators in the other systems do or prepare themselves for? And then looking at that, we're going through a review of an existing regulatory framework, but this time not having backward looking, because there's a tendency to go through what I call the horse stable syndrome, building a very good lock for the stable long after the horse has bolted. Perhaps, and this is where our learning lessons are, is that we should begin building a better stable so that the probability of a horse escaping is minimized. So that's the future-proofing of our regulatory framework. And like I said, the financial sector regulator cooperation. So, ladies and gentlemen, that in a nutshell has been Uganda's experience, the impact on our financial stability, and more importantly, the lessons that we have learned and that we intend to apply. Before, if there are any questions, what we currently are trying to figure out in Uganda is a fundamental question which in some jurisdictions has been answered very clearly, but here still remains something of that depends the guidance of the Minister of Finance and other stakeholders. The question was, Bank of Uganda as a supervisory authority, should it also be the resolution authority? In other words, is the resolution regime where you have a resolution authority separate and distinct from the supervision authority the best, or is it something that we should consider? That to me right now is the fundamental question we are trying to figure out. Ladies and gentlemen, thank you very much.
Thank you very much, Doc, for largely being materially compliant. I think you have exhausted all your 30 minutes. Ladies and of applause for the talk. I now open the floor for any questions or contributions. What's this? Mahmoud here. I think we'll take 3 questions at a time.
Yes. I think I'm getting your name right, Dr. Twine.
Yes, sir.
Or Twine.
Twin.
Twine. Okay, Dr. Twine, thank you so much for that detailed and elaborate presentation. And it's good you also cleared the air about how many institutions were closed, because I think it was, I think the governor too said it is 7, so I think you are the custodian of that information. Thank you so much. Thank you so much for that. Mine, that is a question and a comment. Maybe I'll start with the question. When you talked about global trust, you say that you closed it on a Friday, and by Monday you had sold, you had transferred or sold the assets. Is it that you worked throughout the 2 days to sell the asset, or was there a prior engagement in that? Because I think that would be too magical that within 2 days you sell the assets of a bank. That is 1. 2, you asked a very pertinent question to all of us, your last question. I think the best practice is the resolution authority should be outside the central bank, because central bank is the licensor, the regulator, the supervisor, and it can also not be the resolution authority. So the best practice is the resolution authority should be outside the central bank, and preferably should be sitting with the deposit insurance. Thank you.
Anyone with another question? At the back.
I'm Damien Katota Mali, to Finance Bank. Director, I wonder whether there were any governance issues identified in the resolution of those institutions you have mentioned, because normally governance is a very big factor when it comes to the management of banks. Were there any problems as far as governance was concerned? Thank you.
Thank you so much for the presentation. But for me, one area that is probably not well covered is the area of lesson learned. People who are involved in the management of those banks. I've not seen in any area of your presentation where those people actually brought a book. Because in taking lessons, you must also show examples. So the law should be so comprehensive enough to bring people to book, so that it can prevent such occurrence in the future.
Maybe just give Rosen.
Dr. Twine, it's a pleasure to have you here. My question is related to financing these resolutions. I'd like to hear from you more about how these resolutions were financed, who bore the losses, and do you draw some lessons on that front?
Thank you for the questions. Doc, you have the floor.
Let me start with the last one. The financing of these resolutions. In the structure for Global Trust and National Bank of Commerce, NBC, there was no net effect significant effect on the Bank of Uganda's balance sheet. Because in the purchase of assets and assumption of liabilities, especially the depositors, are taken on by the acquirer and in turn they are given the equivalent in assets to match the liabilities they assume. In actual fact, for the case of Global Trust, it was found that the assets that were being given to the acquiring bank were slightly less than the liabilities the bank was being asked to assume, in which case the resolution authority, which was Bank of Uganda, paid the acquiring bank and some money. Okay? So for those, and that's the beauty of purchase of assets and assumption of liabilities, the impact, first of all, on the depository insurance scheme, the impact even on the resolution agency is minimal. Okay? Crane Bank, slightly different. Crane Bank, one of the fundamental issues, and which kind of answers the question someone asked earlier on about governance, where while all these three banks had governance issues, the governance issues in Crane Bank were significantly larger. That's one. Two, it was a systemically important bank in terms of its reach, balance sheet size. So there were not too many entities that had the ability to swallow it, so to speak. So there was there was selective assumption of selective liabilities for which matching assets were provided. The excess assets, which were considered of diminished quality, were then retained by the receiver. But for Crane Bank, because we also took the bank through a 4-month period of statutory management, Bank of Uganda then grew its balance sheet to be able to extend liquidity support. So that impact, however, we've had to report on our balance sheet and has created a significant dent on the central bank's capital base. So, while you might say, but wait a minute, so in the lessons learned, how come you have not mentioned the funding of these institutions? I think I did. If you look at early intervention under risk management, risk mitigation, one of the things under risk mitigation, if I was to blow it up, is that a priori, either with the agreement that the central bank with the Minister of Finance or the Treasury should agree, have permission or authorization to grow the balance sheet to be able to fund certain bank resolutions in the event that's necessary. Of course, it then is also conditioned on what the gentleman from the Deposit Insurance Scheme from Kenya said, the CEO, was if the resolution agency is different from the central bank, then that agreement with the Treasury should be with whoever is doing the resolution. That in advance, maybe and perhaps once a year it's reviewed, the Treasury allows the resolution authority to either grow its balance sheet or have access to certain funds to be able to conduct any resolution in the event it happens. That way, when you are moving into a resolution, you don't have to go back and such, because in the resolution, the more people that know about it, that is likely it's supposed to succeed. Which then takes me to the question of how do you take over on a Friday and have a new owner on a Monday? Once the decision to take over is made, and perhaps if you'll allow me to go back earlier on, once the decision to take over is made, and you determine perhaps that the bank is not, whether it's systemically significant or not, at that point, there will be a team that then decides, asks quietly which institutions might be interested. And this normally happens 3, 4, 5, 6 months before. They sign those that might be potentially interested are approached, they sign the disclosure agreements, and then because at that point the problem institution is probably under close or daily monitoring, the supervision authority then makes available data, performance data, financials of the institution under question or under consideration, available to those who are interested in perhaps acquiring it. So then, and that's for Global Trust and also for NBC, the discussions happened over a 3 to 6 month period prior to the actual takeover date. So when by the time there's a takeover, there has been a discussion behind the scenes for about 3 to 6 months in this process. Now, to minimize the impact is that that's it's also an approach taken by a number of resolution authorities, is that you walk in on perhaps just before a weekend or a public holiday with the entity that you have agreed to take over. Of course, in the purchase of assumption of purchase of assets and assumption of liabilities agreement, you build in certain safeguards, maybe perhaps that the acquirer has up to 60 days to verify and confirm that which they are taking over and have the ability to return or not return. So that is how it is possible to take over a bank on a Friday and have a new owner running it on a Monday. There was a question on governance. I think I mentioned it, but governance indeed has been the common thread throughout. It's been the common thread throughout all these resolutions, which basically means it's the people problem. Because if the people have, and if the people are the problem, then the question becomes, how do you get them to do the right thing? There could be a threat of jail. We could go the approach of maybe arranging for corporal punishment for non-compliant managers, but that doesn't get you the action that you want. Like I said, we are beginning to borrow a bit from behavioral science and behavioral economics, that people respond to incentives. Structure the incentives right, and you'll get people to do that which you desire. So on the question of saying that, in lessons learned, how come there was nothing specific about people? It's under behavioral change. It comes under risk management, but also more importantly under other warning indicators. Borrowing again from behavioral science, we look at what makes people make the decisions they do. Why do people make the decisions they do in the way that they do? Sometimes there have been various books and literature on this matter. Why, otherwise intelligent people make seemingly irrational decisions is the presumption that everyone makes rational decisions. Does a rational mind exist? These are fundamental questions that remain unanswered in economics, and that's why economics now borrows from psychology. But we've since realized that if the incentive structure for good behavior, both incentive in terms of with consequences and rewards for good conduct or good behavior, if that is done right, the people question gets solved. And that's why we have if you look at the early intervention, financial institution conduct and management behavior change. So that's where the people issue is addressed. And lastly, I will agree with the CEO for the deposit insurance scheme in Kenya that while they agree there is a trend of separating the resolution role from the supervisory role, and increasingly the resolution role is being assigned to the deposit insurance scheme. But in Uganda, the fundamental question is we have to ask, does the deposit insurance scheme have the capacity today to take it on? Should it be a transitional, assign the role, have the existing person playing the role, slowly over time building the capacity within the institution? Unfortunately, that is something that requires us going to Parliament, getting the consent of the Treasury, going to the Parliament and amending the whole new law. What's the process for the law? In the interim, what do you do? So while I agree with what the worldwide trend has been, that deposit insurance schemes are increasingly becoming responsible for the resolution of institutions, or failed institutions, or problem institutions, on a case-by-case basis, one has to turn and look at the unique peculiarities of the legal and regulatory framework within a jurisdiction to determine how that's best done. But also, two, in the case of Uganda, and I believe this will probably apply in other jurisdictions, there has got to be a way on how the deposit insurance scheme will be funded to be able to undertake this role. I've not had an opportunity of looking at the numbers of all the various deposit insurance schemes, but I think the target is as long as you can be able to cover 90% of the eligible deposits, you're considered to be reasonably doing well. But resolutions normally might demand much more significant sums. So now the question is, does the Treasury, should there be some kind of tripartite between the central bank, the Treasury, and the resolution agency to be able to handle that role? Those are the questions we are currently trying to grapple with in Uganda. But I do agree with you, it should be separated, and I believe the best home for that role is with the deposit insurance scheme.
Thank you very much, Doc, for that concurrence. Anybody else with some questions?
Thank you. My name is Fredo March from Pride Microfinance. Thank you, Dr. Twine, for this very elaborate presentation. My question is about the macroeconomic stability, which may not be directly in the hands of the central bank, presumably in the hands of the Ministry of Finance of government. So to what extent in Uganda and maybe other countries are these contributing to failure of banks, the economic stability in the country, the role of the Financial Intelligence Authority, the over-liberalization, and then there is total excess banks in the economy, the issue of provisioning, the laws and regulations that really the banks find themselves completely getting out of this, and then the issue of where you have given out loans to your customers, and the customers have supplied government with the services, and government is not paying them, and then you're selling of their properties. To what extent is this contributing to these failures? Thank you, Chair.
Thank you, Dr. Twine. My name is Edna Kanabaita from Barclays Stroke ABSA. My question is in relation to escrow accounts, which you mentioned in your opening remarks. These depositors, which may be indirectly or directly bank account holders, and extending it to agents within the banks, how are these indirect depositors protected? Are they collectively or individually insured?
Doc, you can answer those two questions.
Thank you. I'll start with the last question. The escrow account. The ongoing discussion has been, especially for Uganda's case, we largely have the escrow accounts holding mobile money deposits. So balances that were in the wallets, which are significant sums with a multiple number of persons with a share. So for the deposit insurance scheme, and I believe we've had a couple of discussions with them, is should the insurance be per wallet or for the whole account? For the whole account, the current limit that we have, which we just raised to $3,000, would not apply because the average balance on an escrow account is nowhere less than $30 million. That's the average balance. So how do you do it? Do you have a pass-through? If you have a pass-through, then who pays for it? Okay, that's the issue, and we're trying to look around and see what other countries are doing about it and how they're trying to handle it. But as a stopgap, as a temporary measure, the one approach would be that In the event a bank is going to be subject to resolution, it should be deemed that the assets in the escrow account should not be available for the resolution of that bank. That would be a first stopgap while we figure out how to deal with those within, how to ensure the holders of the contributors to the escrow account. On the issue of macro stability, see, macro stability has got two aspects to it. There's fiscal and monetary. The fiscal policy, fiscal stability, it purely under the Treasury or the Minister of Finance. The monetary falls under the central bank. Now, when, in the example you gave, when government runs up significant arrears to the private sector, which private sector has now borrowed from the financial system, yes, you might have what I would call it contagion, perhaps cross-pollination of bad manners. So the government runs up arrears, is unable to pay with the private sector has borrowed from the banking system, they're unable to pay back their loans. However, the banks, because they have lent out depositors money, must be in a position to have buffers, capital buffers, and ensure that depositors at any one time are properly covered. The unintended consequence of that is that then you end up having the private sector not wanting to supply government, and government having to purchase its goods expensively, which then means government needs to raise more revenue, and it then raises taxes. So there's a circular issue, the chicken and egg, which came first. From a supervisory point of view, the concern remains that, like I said, one of the original objectives is the covered depositors and covered investors or creditors at any one time must always be covered. They must always be protected, because that's who our fiduciary responsibility first and foremost lies to. When an institution has been given the license or the permission to collect money or deposits from the public, the first person you want to ensure that public is that whenever you do or want to, you must have access to your funds. So the lending to government or government running arrears with the private sector now becomes a business decision for the banks. And perhaps I believe this has something to do with, when you look at the current, the new standard, the IFRS 9 that kicked in January last year, where now the financial institutions are now required, through the expected credit loss models and probabilities of default, to compute a provision at the time of originating an asset. So that at any one time, should that asset should the quality of that asset deteriorate, because those are funds or deposit funds, they are always protected. So once that is covered, then we now we'll go further and say, okay, because once you have depositors lose confidence in the banking system or the financial system, you technically really don't have an economy remaining. So that's one of the reasons why we take that approach.
Escrow account
I think the escrow account, I spoke about it. So the Bank of Uganda has ongoing conversations with the deposit insurance scheme here on how best to, like I said earlier on, to protect the escrow accounts. But like I said, my opinion, so the Bank of Uganda opinion, my humble opinion is that as a first step, those assets or those holdings should not be part or available in the resolution of any bank that holds them. But then that requires that the either mobile money or digital financial services provider must, the institution holding the account must have full visibility in terms of into the platform on which the digital finances run. That's one. Two, you must ensure that for every shilling, kwacha, pound, dollar that's in the escrow account is matched by electronic money. So there should always be a one-to-one relationship between the two. How then you protect the individual contributors to the escrow account is, one, you can have individualized deposit insurance, which, especially for Uganda's case, where most of the money is from wallets, and the balances on an individual basis are not that significant, because the average transaction in Uganda is about 24,000 shillings, which is under $7. So if that is the average balance on an account, well, what are you going to charge? And remember, this is a balance that moves on a daily basis. So how much are you going to charge as a premium? If someone is only spending 20,000, how much are you going to charge them as a premium? Because even the cost of collecting it or even trying to disperse those monies. Imagine a scenario where a bank has had a failure and you are choosing to, the Deposit Protection Fund has provided coverage. The average escrow account will probably have between 200,000 to 500,000 contributors. How do you even disperse those small monies to them? The cost of even reimbursing them can far exceed any purported benefits of having that scheme. So there's got to be a decision whether perhaps the one thing I can think of is to say that the funds in the escrow can be able to create interest or earn interest, but a portion of that interest must be forfeited to the deposit insurance scheme as a contribution for protection. That's one alternative. So there are a number of ideas up in the air, but we haven't yet settled on one, and because it's a discussion we as the central bank are having with the deposit insurance scheme here.
Thank you very much, Doc. Ladies and gentlemen, we have come to the end of this session. Can you join me in applauding the Doc for his eloquent presentation? At this juncture, I will hand over to the Master of Ceremonies. Thank you very much.
Thank you, Mr. Vuma. Let's give him a round of applause as well for moderating that session. Just a few announcements before we move on to the next part of our program. There are lovely pink and white forms that have been handed out. These are evaluation forms to help us assess how much you enjoyed the conference. So kindly fill these in, and you'll just drop them off at the registration desk on your way out. I know a lot of people are interested in the presentations, the speeches that have been delivered over the last 3 days, as well as the photos that you were part of. We're going to share those on our Google Drive link, so just make sure you share your email address when you're registering, and you will get a link with all those details. Announce the IRD members so that everyone is aware who is expected to be in the annual general meeting next door. The member states or deposit insurers are Angola, Ghana, Kenya, Mali, Morocco, Nigeria, Sudan, Tanzania, Uganda, and Zimbabwe.